There is a pattern for how financial empires collapse. It doesn't happen overnight. It happens in stages. In our last exploration, we decoded the blueprint. We showed how the $38 trillion national debt isn't an accident, it's a feature. It's a 300-year-old system designed by architects like Patterson, Rothschild, and Morgan to ensure that debt is permanent, infinite, and inescapable. But this leads to the one terrifying question the architects never wanted you to ask. What happens when the interest on that debt becomes so large it can no longer be paid? What happens when the system finally breaks? You think your money is safe. You check your savings account, your 401k, your deposit box. It's insured, right? Protected by the government, the FDIC. That is the illusion. That is the lie they tell you to ensure your compliance. Because what if I told you that in the next crisis, the government has no intention of bailing out the banks with taxpayer money? What if I told you the law is already written for them to bail in? A bailout is when the government prints money to save the banks. A bail-in is when the banks seize your money to save themselves, your savings, your checking, your deposits. Legally converted into bank stock, moments before the bank goes bankrupt. You don't just lose your money, you become the owner of a failed institution. This isn't a conspiracy theory. This isn't speculation. The law was passed in 2010. It's called the Dodd-Frank Act, and the historical precedent was set in 2013. They've already tested the system, and it worked perfectly. This is the kind of hidden history, the kind of documented truth that the mainstream media refuses to report. They rely on your ignorance. They depend on you to keep trusting the system. We, on the other hand, rely on your curiosity. This channel is not for everyone. It is for the small percentage of people who want to understand the pattern before it repeats, who want to see the truth before it becomes common knowledge. If you are one of those people, do one small thing right now. Subscribe to this channel and turn on the notifications. We are building a community dedicated to decoding the playbook. The answers are not in tomorrow's news. They are written in the past. And by joining us, you are taking the first step to protecting yourself and your family. We are finding the answers together. Now, let me show you the historical template for the Great Bail-in and how the law passed in America guarantees that you will be the one to pay for the next crash. First, we must go to 2013. We must go to a tiny island in the Mediterranean. We must go to Cyprus, because what happened there wasn't a tragedy. It was a dress rehearsal. The banking system in Cyprus was collapsing. It was massively over-leveraged, holding billions in toxic Greek debt. The banks were insolvent, and the government had no money to bail them out. The people of Cyprus did exactly what you would do. They trusted the system. They believed their deposits were insured up to 100,000 euros. Then, on Saturday, March 16th, 2013, they woke up. The banks were closed. The ATMs were shut off. The government had frozen every single account in the country. The Troika, that is the European Central Bank, the IMF, and the European Commission flew in. They gave the Cypriot government an ultimatum. There would be no bailout. The era of government-funded rescues was over. It was time for a bail-in. The government, trapped, passed a law overnight. At first, they proposed a one-time levy on all bank accounts, even the small ones. The people rioted. The parliament rejected it. So the bankers came back with a second, more surgical plan, a resolution. If you had under 100,000 euros, your money was supposedly safe, though you still couldn't access it. But if you had over 100,000 euros, if you were a successful small business, a retiree, someone who had saved their entire life, the resolution was simple. 47.5% of your money was gone. Instantly. It wasn't taken. It was converted. It was seized by the bank and transformed into worthless bank stock. Your life savings were used to pay the bank's bad debts. People went to the ATM and saw their life's work vaporized. Businesses that had millions in payroll accounts on Friday were bankrupt by Monday. It was legal. It was fast. And it set the precedent. The officials who designed the Cyprus bail-in didn't call it a failure. They called it a successful template. A new model for dealing with bank failures. And just 3 years earlier, in America, J.P. Morgan's associates and government officials had already written that template into law. The law is called the Dodd-Frank Wall Street Reform and Consumer Protection Act. It was signed in 2010 in the ashes of the 2008 financial crisis. And the promise, the public-facing sales pitch, was simple. This ends, too big to fail. Never again, they said, would taxpayers be forced to bail out reckless bankers. But buried deep inside the 2,300 pages of that law, under Title II, is the mechanism that ensures the exact opposite. Title II is called Orderly Liquidation Authority. It sounds boring. It's designed to sound boring. But this is the legal machinery that makes the Cyprus bail-in the law of the land in the United States. Here is how it works. When a massive bank, a systemically important financial institution like JP Morgan or Bank of America, becomes insolvent when their bets go bad and they are about to collapse the 2008. Bailout is, in theory, illegal. The government cannot or will not just print trillions to hand to them. Instead, the FDIC, the same agency that supposedly insures your deposits, steps in to manage an orderly liquidation. But they don't liquidate the bank, they save it. They use a strategy called Single Point of Entry, or SPOE. This strategy allows the government to seize the parent holding company of the bank, the single corporation at the top of the pyramid. The operating bank, the part where your checking account and mortgage are, is allowed to continue functioning. But the parent company, which is now technically bankrupt, must be rear capitalized. It needs new money to absorb the losses. And where does that new money come from? It comes from the bank's unsecured creditors. And this is the secret they have hidden in plain sight. This is the single most terrifying piece of financial legislation in modern history. Who is an unsecured creditor to a bank? You are. Legally, any deposit you hold in a bank account that is over the FDIC insurance limit, currently $250,000, is classified as unsecured debt. You have lent the bank your money. You are in line with all the other major lenders, the hedge funds, the pension funds, and under Title II of Dodd-Frank, in a crisis, the government has the explicit legal authority to take all of that unsecured debt to your savings and convert it into equity, into stock, the same worthless stock of the failed bank, just as they did in Cyprus. Let me be perfectly clear. If you have $500,000 in a savings account, $250,000 is insured. The other $250,000 is not a deposit. It is a loan you made to the bank, and when that bank fails, the government is now legally empowered to steal that $250,000 from you to pay for the bank's failure. You won't get a check. You won't get a warning. You will get a letter informing you that you are now a proud shareholder in a bankrupt institution. Your cash is gone. This isn't a loophole. It is the plan. It was designed by the very same financial architects who caused the 2008 crisis. Think about who this targets. It doesn't target the mega-rich, whose assets are diversified in art, real estate, and offshore accounts. It doesn't target the poor, who have less than the insured limit. It targets the heart of the American middle and upper middle class. It targets the small business owner who keeps $1 million in an account for payroll. It targets the retiree who just sold their home and has $800,000 in cash, waiting to buy a new one. It targets the responsible, the savers, the very people who thought they were safe. The 2008 crisis was a bailout where taxpayers paid. The coming crisis, the one they are preparing for, will be a bail-in where depositors will pay. Cyprus was the test run. Dodd-Frank Title II was the weaponization. They told you they were ending too big to fail. What they actually did was pass a law that gives them the power to sacrifice you to save the system. But why? Why would they create a system that guarantees the theft of private savings? Because the alternative is so much worse. The architects of this system know something you don't. They know the $38 trillion in national debt, the $315 trillion in global debt, is the bubble. But they also know the bubble that cannot be allowed to pop is the $2.1 quadrillion derivatives market. 2.1 quadrillion. That number is so large, it's meaningless. Let's put it in perspective. The entire global economy, every product, every service, every cup of coffee, is $105 trillion. The entire planet's real estate is worth about $380 trillion. The derivatives market is $2,100 trillion. It is a financial Death Star, a shadow economy of bets, swaps, and contracts that dwarfs all real-world value. It is a bet on the price of oil, a bet on the interest rate of a Japanese bond, a bet on whether a Greek company will default. It is a web of interlocking bets made by the world's largest banks. And this is the secret. The $38 trillion in government debt is the collateral for this shadow system. When JP Morgan makes a bet with Deutsche Bank, they don't use cash. They post U.S. Treasury bonds as collateral. Government debt is the base layer, the casino chips, for the largest casino in human history. When the 2008 crisis hit, It wasn't the subprime mortgages that almost ended the world. It was the credit default swaps, the derivative bets on those mortgages that nearly bankrupted every bank simultaneously. The system cascaded just as the architects planned. And the bankers, the ones who met on Jekyll Island, they learned their lesson. They learned that the real threat isn't a housing crash. The real threat is the detonation of the derivatives market. So, they passed Dodd-Frank. They created the bail-in. Why? Because they know the next crisis is coming. And they know they cannot bail out a $2.1 quadrillion bubble. The US government cannot print that much money. It would hyperinflate the dollar to zero overnight. The only solution is to find new money before the derivatives unwind. This is the entire purpose of the bail-in. It is not to save your local bank branch. It is to save the parent holding company before its derivative bets collapse the global system. They need a new source of capital, a new source of money to absorb the losses. And they found it. They found it in your savings account. They found it in your 401k. They found it in your small business payroll. The Cyprus bail-in of 2013 was the test. They proved they could seize 47.5% of unsecured deposits, convert it to stock, and the world wouldn't end. The system held. The template was proven. And now, that template is aimed directly at the heart of the American middle class. They have engineered a system where the public savings are now the first line of defense for the bank's most reckless bets. They told you the FDIC sticker on the door would protect you. But that sticker only protects you up to $250,000. Anything above that, you are an investor. You are a lender. You are, in their eyes, the bail-in capital. You are the orderly liquidation. This is the fourth and final stage of the debt trap. First, debt was made permanent. Second, it was made global. Third, it was made infinite. And now, with the bail-in, the public has been made the legal backstop for its inevitable collapse. They have created a closed loop. The government borrows from the Fed, creating debt. The banks use that debt as collateral to create quadrillions in derivatives. When the derivative bets fail, the banks are legally empowered to seize your deposits to recapitalize themselves, allowing them to continue holding the government debt, which allows the government to continue borrowing. It is a perfect, inescapable system, and you are not the customer. You are the fuel. The system isn't broken. It's working exactly as designed. The $38 trillion in debt isn't the problem. It's the $2.1 quadrillion in derivatives that the debt supports. And the bail-in is the final, desperate measure to protect that derivatives market at your expense. So where are we now? We are in the final stage of the pattern, the stage of decay. The debt is now so large, at $38 trillion, that the United States government is spending over $1 trillion per year just on interest payments. Think about that. That is more than the entire defense budget. That is more than the budget for Medicare. That $1 trillion is not building roads, not funding research, not paying for hospitals. It is a direct, electronic transfer of wealth from you, the taxpayer, to the bondholders, the institutions that own the debt. This is the debt spiral we decoded in our previous episodes. A government must borrow new money just to pay the interest on the old money. It is the mathematical definition of an unsustainable system. And the architects know it. This is why we saw the bank failures in 2023. Silicon Valley Bank, Signature Bank, First Republic. The media told you this was a small, isolated problem. They told you it was mismanagement. That was a lie. It was the first crack in the dam. Those banks didn't fail because they were stupid. They failed because the Federal Reserve, in its war against inflation, raised interest rates. And when interest rates rise, the value of the old government bonds, the safe collateral, collapses. Those banks were sitting on hundreds of billions in safe U.S. Treasury bonds that were suddenly worthless. The bail-in mechanism was almost triggered. But the government panicked. They knew the system wasn't ready. They knew the public wasn't prepared to have their savings confiscated. So they did one last, desperate bailout. They created a new program, the Bank Term Funding Program, or BTFP. This program was a shadow bailout. It allowed banks to give the government their worthless bonds and receive 100 cents on the dollar, full face value, in cash. It was a $165 billion stealth rescue. But that program has now expired. The temporary fix is gone. And the banks are still sitting on over $650 billion in unrealized losses. The trap is set. The crisis was not solved. It was merely delayed. The next time a bank fails, there will be no BTFP. There will be no government check. The media will call it regrettable, but necessary. The president will read a teleprompter. assuring you it is for the stability of the system. And then, the orderly liquidation authority will be triggered. They will activate Title II of Dodd-Frank. And overnight, your savings account, your business's operating cash, your retirement nest egg, it will be converted. It will be bailed in. You will become the lender of last resort. You will pay for their $2.1 quadrillion casino. This is not a prediction. This is a reading of the law. This is the playbook. They wrote it down, they passed it, they tested it, and they are waiting to use it. They have created a system where your wealth is the collateral for their failure. The four architects Patterson, Rothschild, Morgan, Volcker are not just historical figures. They are the designers of the room you are standing in, and the doors are locked. The system was designed so that you can never, ever escape. But what if there is one asset they cannot control? One asset that exists outside this system? For 6,000 years, there has been one form of money that cannot be printed by a central bank, that cannot be bailed in by a failing government. An asset that has no counterparty risk, no debt attached, and no CEO. An asset that has outlived every single fiat currency in human history. They don't want you to think about it. They call it a pet rock. They call it a barbarous relic. They call it tradition. They call it that because it is the only true threat to their system of infinite debt. They cannot print it, they cannot control it, and if you hold it, they cannot seize it. That asset is gold. For thousands of years, gold has been the universal measure of value. It was money long before William Patterson was born, and it will be money long after the Federal Reserve has turned to dust. Why? Because it is the ultimate antithesis to their system. Their system is built on debt. Gold is the elimination of debt. When you pay with $1, you are handing someone an IOU from the Federal Reserve. When you pay with gold, you are handing them final payment. The transaction is closed. Their system is built on infinite supply. The Fed can create trillions with a keystroke. Gold supply is finite, governed by physics, geology, and human effort. It must be mined from the earth. It cannot be printed to fund a war or bail out a failing bank. Their system is built on counterparty risk. Your bank deposit is a promise from the bank. A stock is a promise from a company. A bond is a promise from a government. Gold is the only financial asset in the world that is not simultaneously someone else's liability. It is the only asset that holds its value in a vacuum, requiring no promise, no government, and no banking system to be valuable. This is the hidden history they don't teach you. Why did President Roosevelt outlaw the private ownership of gold in 1933? Was it to stabilize the economy? No. It was to seize control. He needed the gold to fund the New Deal and gain total control over the money supply. A population that holds gold is a population that cannot be easily controlled, because their wealth is not tied to the government's promises. Why did President Nixon sever the dollar's final link to gold in 1971? To create flexibility? No. It was to unleash the system of infinite debt. The gold standard was the last cage holding the bankers back. It forced the government to be responsible. By removing it, he gave the Federal Reserve the green light to print, to borrow, and to build the $38 trillion debt monster we have today. And now, look at the pattern. What are the central banks of the world doing right now? While they tell you gold is a pet rock, China, Russia, India, and Turkey are buying gold at the fastest pace in human history. They are engaging in massive de-dollarization. They are quietly dumping their U.S. Treasury bonds, the paper promises, and converting them into physical gold. Why? Because they are the architects. They know the game is ending. They know the system based on the U.S. petrodollar is fracturing. They know that when the $38 trillion in debt finally implodes, the only thing left standing will be the asset that has stood for 6,000 years. They are preparing for the end of the debt system. The question is, are you? The bail-in law, Title II of Dodd-Frank, gives them the right to seize your unsecured digital and paper assets. Your savings, your checking, your 401k. But they cannot seize what they cannot find. They cannot bail in an asset that exists outside their digital system. This is the final move in the chess game. This is the escape hatch from the trap. We have now decoded the full pattern. Patterson made debt permanent. Rothschild made it global. Morgan made it infinite. Volcker made it inescapable. And the Dodd-Frank Act made you the final backstop. They did not design a system that is failing. They designed a system of permanent, organized wealth transfer. It is not broken. It is working exactly as they planned. The $38 trillion debt is not a crisis for them. It is a business model. The $2.1 quadrillion derivatives market is the casino. and your savings account is the final pile of chips they intend to grab when the house of cards comes down. If this video opened your eyes, if you finally understand that the bail-in is not a conspiracy theory, but a documented, past, and tested plan, then you are starting to see the true pattern. If you want to continue this journey, if you want to understand the next stage of the collapse and the historical patterns that predict it, then do one thing for us, and for yourself. Subscribe to this channel. We are building a community of people who are not afraid to look at the truth. Because when the next crisis hits, when the ATMs are dark and the media is telling you to stay calm, you will want to understand why it's happening. You will want to be part of a community that saw it coming. And share this video. There are people you care about, your family, your friends who are currently asleep inside this trap. They believe their money is safe. This video is the warning they need, the red pill they must take. Finally, comment below. What is the one thing you learned today that they never, ever taught you in school? The answers are not in tomorrow's news. They're written in the past, and we are here to decode them together.